Get our first management conversation going for the day, and it's Crompton Greaves Consumer, which is in focus. The fourth quarter numbers were in line with street estimates, aided by strong revenue. Let's connect with Kaleeswaran Arunachalam, the Chief Financial Officer of the company, to discuss the Q4 performance in detail. Mr. Arunachalam, your sales growth was supported by the ECD segment. What kind of volume and value growth do you envisage for the segment in FY25 and perhaps for the company as a whole?
To start with, as an organization, we don't provide forward guidance. But having said that, I would like to delve a little bit more on what has happened in FY24. It's been a year where we transitioned into Crompton 2.0 effective Q2 onwards. And extremely glad to state that after many quarters and years, Crompton has reverted back to double-digit revenue growth on a standalone basis. This is aided by very, very strong performance across all the categories in ECD. For example, for the first time ever, maybe we are the largest player in the world and the first one to cross 2 crore fans to be sold. So that's one of the big milestones that we have achieved. We have also seen broad-based growth across categories in ECD. Our pumps business on a full year basis have grown at double digit. Our appliances business, led by both our LDA and SDA portfolio, is tracking at 25% plus growth. The new initiative that we have started in large kitchen continues to grow and continues to expand. And one of the main focus areas that we called out is how do we arrest the decline that we have been going through in our lighting business. I'm extremely glad to state that the lighting decline has also been arrested, and all these are happening amidst very strong improvement in our margins. If you look at the category-wise margins, ECD margins have expanded significantly. We started the year at around 12% EBIT margin in ECD. We are now inched almost close to 17% in ECD. Lighting margin, in spite of the challenges that we had during the year on account of price erosions and competitive intensity, EBIT margins in lighting have also expanded. The other business, the new baby in our portfolio, which is Butterfly, that we recently acquired about a couple of years back, it's still in transition. It's work in progress. We are looking at corrective actions that we have to take to ensure that it pulls its weight as a brand and a leader in the kitchen category. Some of these things were around how do we de-risk some of our non-core channels and also start moving towards retail business led by trade and RCS. So that journey is moving on in the right direction.
All right, Arunachalam, currently Butterfly contributes close to 8% of your revenues. Long term, where do you see this number going? And also, when do you see Butterfly's margins turn positive?
Start with the kitchen is the largest segment that we play as a group. There is Butterfly, which we recently acquired. And there is Crompton Kitchen, which comprises of the mixer grinders, wet grinders, and the garment care segment that we operate within Crompton. And then there is a built-in kitchen that we have in Crompton as a portfolio, which has the chimneys and hobs business and the microwave ovens, which is also helping us to premiumize the overall portfolio and the brand Crompton. Now, specific to Butterfly, there has been certain interventions that we had to make in terms of the channel corrections that we need to do. Largely, that has been completed. As we move forward, we look at the business to grow at a double digit in the long run. And in the near term, probably whatever the correction that we need to do and take the charge on margin, etc., by and large has been completed. As we look forward to next year, we want to make this business a very strong, solid leader in the categories that we operate in. Today, if you take Crompton plus Butterfly together, we are already a number 2 player in the kitchen appliances category. And we have already have a portfolio of kitchen that we have been growing very strongly at about 30% plus for the last 2-3 years, which is the Crompton small domestic appliances. We should be able to translate those learnings into Butterfly, make Butterfly grow at a double-digit business and get it on track to about 8 to 10% EBITDA in the long run. So that's what we're looking at. I think as we move forward, step one, the margins would be positive in FY25 and the margins would also start to expand from there onwards.
Mr. Arunachalam, good morning. Now, lighting business revenues remain flat. Margins are also down there, about 180 basis points. Could you share with us what is the growth trajectory and outlook on that side from here on?
See, lighting, if you look at it, first and foremost, then the margins that you're seeing in lighting and Crompton as a whole plus Butterfly is impacted by a full year liability crystallization towards extended producer responsibility. This is a recycle initiative that has been started by Government of India, and we have taken about 6 crores of it in our lighting business and 15 crores overall as a group. So if I adjust for that and look at lighting margin, the lighting margin has expanded in Q4 also. From an overall business perspective, our B2B portfolio is doing very well. We have created an enterprise vertical, which has helped us to win very strong orders. This constitutes both one with the National Highways authorities and also some of the corporate orders that we could get with marquee clients. Now, coming to B2C, B2C as a category continues to see price erosion. This is largely in the bulbs category, followed by reasonable price corrections that are seen in ceiling and battens also. We haven't undertaken any price increases in lighting, considering that the category is already going through a price challenge. The way that we are trying to grow the margin is by taking 2-3 actions. One, we have a project Unnati, which helps us to focus on the overall cost of the company and see how do we drive at least 4 to 5% productivity on a year-on-year basis. Our new product launches that we are making are also made as fit to purpose, which is helping us to improve the margin. The third is driving better mix. We see there is significant opportunity for us in our lighting portfolio to push ceiling category as compared to other bulbs and battens. So over a period of time, when the saliency of ceiling goes up, this will also help us to expand margin. So lighting overall, the decline that was there when we started the year, which was almost at a double-digit decline, has been arrested. We are on to growth path. B2B is delivering strong growths. We expect B2C also to follow, and margins would remain strong as we have seen already in FY24.
Mr. Arunachalam, I know you've said that you don't give out specific guidance, but let me try to get a general outlook at least instead for the current year on revenue as well as on margins.
When we started with Crompton 2.0, we want to deliver a strong competitive performance, both in terms of revenue and bottom line. The idea was start with a double-digit revenue growth. We have achieved that in FY24 after many quarters and years. We expect that to continue and expand the revenue growth as we are looking at FY25. The summer has started positive. Let us see how does that move forward. So as far as margins are concerned, we called out that we would be focusing on absolute profits and ensure that the absolute profit growth is more than the revenue growth. This in the long run will help us to expand the EPS and create value for all stakeholders.
Okay, well, we'll leave it there, Mr. Arunachalam. Great to have you with us here. Good luck. Thank you for that chat this morning here on CNBC-TV18. We'll take a break. We are back with Nischal Maheshwari, CEO Institutional Equities, Advisory, Centrum Broking, with some fundamental stock chat. Stay with us.